Hi, everyone. Welcome to the Yes Investment Club. This is the fifth chapter of the basic investing course. And this chapter will focus on primary and secondary market. In the stock market, you can invest through two types of markets, which is the primary and secondary. And this chapter holistically covers the two markets by explaining the difference between them and making you understand the process of trading in the different types of markets. Additionally, this chapter will also unpack the power of compounding, which is an art of making money out of your current money. And lastly, we will teach you how to open an investment account in a short span of time so that you can apply this learning and start investing at an early age. So the syllabus for this chapter 5 will entail, first of all, primary market. Inside primary market, we'll cover the IPO, which is the initial public offering, then the benefits of an IPO. Then we'll go on to the types of IPOs and how to apply it to an IPO. And lastly, the allotment of shares for the primary market. Then we'll move on to the secondary market, in which we'll talk about the functioning of the secondary market, the positive and negative movement, and the stock trading mechanism. And then we'll move on to the power of compounding, which is actually important to understand for us to trade. And lastly, we will just cover how can teens start investing, which is an important question for you to understand and implement the learning and start the journey of investing and trading.
So first, we're going to begin by understanding what the primary market is. The primary market itself can be summed up in one singular sentence. So we're going to go through different aspects of the primary market and break it down separately and try and get as much information as we can and teach you about what the primary market entails, how it works, and how you can become a part of it. So let's open up by giving a short story here. So imagine you are a budding entrepreneur with a brilliant business idea to manufacture highly fashionable cotton t-shirts. The designs are unique, have attractive price points, and the best quality cotton is used to make these shirts. You are confident that the business will be successful and are enthusiastic about launching the idea into an actual business. As a typical entrepreneur, you're likely to be hit by this typical problem. Where are you going to get the money to fund the idea?
Well, that's where the angel investor comes in. This is usually the first step for a company to start up. So, an angel investor is usually a person who is either close friends or family of the entrepreneur. And so, these people are investors who invest in the company because they believe it can succeed. Essentially, angel investors are individuals who have faith in the company's success rather than the company's value. So they are also a part of the seed fund, which refers to the initial capital, which is the money that the company gets to use to develop itself. In return, they are also obligated to get the company's shares according to the amount of money that they have invested. And so this is up to the discretion of the entrepreneur and the angel investor themselves. So now that you've received the funding from an angel investor and now you're backed by a good company structure, you need to now move up the social ladder by opening just one small manufacturing unit and one shop to sell your product. This is where the venture capitalist comes in. So, a venture capitalist is a person who invests in the company after it has established a solid foundation. So, the money that the business gets in this stage are called rounds, which have three main Series A, Series B, and Series C. The venture capitalists are also the ones who provide a valuation to the company based on sales data and other estimates provided to them. A good way to learn more about the venture capitalists is to watch the show Shark Tank or its Indian version, Shark Tank in India. So now that you've received three rounds of funding from venture capitalists and your company is phenomenally successful in the past 3 years, your company decides to have a retail presence in at least three more cities. And so to do this, it needs to expand, for which it needs more capital. At this stage, you have no choice but to approach a bank and take out a loan for the amount of money you need. And so making use of this loan, you can expand your business. And once if these expansions are successful, the loan and the interest can be paid back based on the increased revenue that you generate because of these expansions. But a few years pass by and your company's success continues to grow. With the growing success of this, let's say, 10-year-old company valued at 200 crore rupees, your ambitions are also growing. So you decide your company has to raise the bar and branch out across selected states in India. So what do you do in order to carry out such an expansion? Now, the private equity investors comes into the picture. A private equity investor is a highly qualified and successful investor who provides large amounts of capital for significant stakes in the company, usually not a majority stake. These investors only invest in select companies that have been operational for a few years and have reliable income or revenue streams. So, after giving up the private equity in your company and receiving more capital, your company has progressed really well and has successfully diversified its product portfolio and has established a presence across many states. Revenues are good, profitability is stable, and investors are happy. However, you want to do more. You cannot just settle for this. You now aspire to go national, to go across the entirety of India. You want your brand to be available across all major national cities and want at least two outlets in each major city across the nation. So, to do this, you will need a lot of capital. And you cannot go back to any of these other people because they can only give you limited capital. So, what do you do now? Well, your choice is to do an IPO, also known as an initial public offering. So, this is a process by which a company can raise funds with the help of the general public. In this process, the company decides to offer their shares to the general public, like I said. But the general public has to buy the shares. And to do this, if they want to, they have to give a certain price for which the company will offer capital. So they will earn a small amount of equity in the firm, but at the same time, the firm will also get some money because they paid to have such equity in the firm in the first place. So, since the company is offering shares for the first time to the public, it's called an initial public offer. And so, after the company has gone public, it can use these capital and profits for the research and development (R&D) of the company. For all you know, you continue and become a national company in India.
And the important point to note over here is for an IPO, a company has to give 25% of its equity shares to the public at all times. So the rest remaining percentage can stay private, but 25% is a threshold for the company to become public.
Now we're going to be diving a bit more about the initial public offering, the IPO that Annie has just mentioned. So we'll be going over the benefits of it, the types of it, and how to apply for an IPO. Firstly, we'll be starting off with the benefits of an IPO. So the first point is that it's a very cost-efficient way to raise capital. And so in a privately held company, the operations and growth processes are financed using money from the shareholders, investors, and venture capitalists, as we've mentioned. And while this can help a company get started, sometimes it needs to scale up its operations or widen the range of services in order to keep up with the competition, and thus requires a huge capital infusion. And so if the existing investors are unable to raise the required sum, the company has two broad options to choose from: avail of a loan or issue shares publicly. And so while loans can be easy to acquire, if the company is doing good, the interest paid on the loans can sometimes hurt its finances and make profitability difficult. And the main purpose for firms are to maximize their profits. And so, however, by going public, the company can gain capital from the public and only has to give a certain percentage of shares in return, thereby meeting the requirements in a more cost-efficient manner. And the second benefit of an IPO is that it boosts profitability for existing shareholders. So in a private company, a limited number of shareholders invest capital to get the business rolling. However, the brand and market value earned by the business cannot be monetized until the company goes public. And so when a company issues shares, the market price of its shares is based on the general investor's perception of its performance. Hence, if the company has a good presence and a positive brand image, existing shareholders can earn more profits for their shares in the company. And the last benefit is that it enhances the credibility of the company. And so, as we know, the Securities and Exchange Board of India, the SEBI, regulates the Indian stock market. But it has also laid down some stringent norms to allow companies to go public. And so, hence, if a company is launching an IPO, people can be certain that it has passed SEBI's requirements and is, therefore, a very strong company. And this helps improve its overall credibility, thereby allowing it to attract better employees and open doors to new opportunity. And one thing to note is that LIUs LIC's IPO is going to be launched this year, and it's going to be India's biggest IPO, and it's launching on May 12th, 2022, which is going to be very soon.
So let's go over some of the different types of IPOs that do exist. Although there is a broad definition of what an IPO is, there are small changes that you can have and different types that can be found in the primary market. So the first is the fixed price IPO. Under this method, the IPO share price is fixed before it is made available to the public. The price is usually set by evaluating the total assets, liabilities, and every other financial aspect of the company. And then the IPO price does not fluctuate depending on its demand from the public. The second is the book building IPO. Book building is a term we have encountered before in the earlier chapters, but in a book building IPO, the price is determined by investor sentiments and feelings about the company. There is no real fixed price, but a price band instead. The price band is decided based on the demand and supply of the shares in the market, which is found through market research. The majority of companies adopt the book building practice because it allows them to see the market response from investors, meaning that no matter what price band they set, the investors will be able to give a range for what value they feel is acceptable for the IPO, and then the company can use that to set their fixed price later on. The third type is the offer for sale IPO. The offer for sale is a mechanism that allows promoters, like the founder or board of the directors of the company, to reduce their own personal holdings in a listed company transparently. These shares sold by the promoters are offered for sale directly to the public through a bidding process. An OFS is often considered a type of IPO, OFS being offer for sale. It's a type of IPO because the promoter's shares are privately held, as in not listed in the stock exchange. By selling these personal shares to the public, they are making the shares become public, thereby putting in fresh shares into the market. The last type is a follow-on public offering. The follow-on public offering, or FPO, is the issue of shares by a publicly traded company after it has already gone public. These shares offered in the FPO are also referred to as secondary offerings because they are shares that are offered right after the company's initial IPO. It enables the company to raise more capital for its interests. An FPO has no special procedure because by the time the shares are offered, the company is already listed on the stock exchange, so these shares in the FPO are traded much more normally.
Right. Okay. So let's move on to how a company applies for an IPO. So first step is appointing a merchant banker. So the companies appoint a merchant banker or an investment bank, which will advise and help the company in the entire IPO journey and provide underwriting services. Step 2 is DRHP. The DRHP stands for Draft Red Hiring Prospectus. So this is a document prepared by lawyers under the supervision of the merchant bankers. And this document serves as the investment thesis to convince the investors onto why to invest in the company. And SEBI casts the responsibility of due diligence of everything written in the draft prospectus by the merchant bankers. So the DRHP is actually an official document that you would be wanting to see to understand what the company looks like, what the financials are. Everything is given in that document, and the SEBI particularly looks and checks the facts mentioned in the DRHP so that the investor gets the right information. Step 3 is actually applying to SEBI. So because the application to SEBI is required because they have to authorize the IPO before launching it, right? So this is done through a registration statement and the DRHP, which is given to the SEBI, and then the SEBI checks it. And the merchant banker is responsible for coordinating with the SEBI and satisfying the SEBI's queries and getting the SEBI approval to the market so that the shares can be issued to the investors through the IPO. And here there are several rounds of back and forth movement because SEBI raises many queries with regards to companies' financials, their performance, and their indicators, so that they understand that the company is a good fit for going to the secondary market and it will not create a bad performance in the market. So after going through the registration statement and DRHP, the SEBI then gives a go-ahead sign. Certain times it can say no because looking at the financials of the company, they can reject the IPO. Step four is marketing. So under step three, it was the most important part because they need an approval from SEBI. And by receiving the approval, as Sophia previously mentioned, it is getting the company's name on the board, which is like making the company strong because they have passed through all the SEBI regulations. So after receiving the approval, they move on to the marketing part of it. So this marketing part is actually very important because it raises public awareness about the company's IPO. And this is called as the IPO roadshow because this can be done through the places like TV or printed media. And you'll obviously see this like in newspapers. There are one page whole, there's a prospectus given, and it informs the investors that this company IPO is coming, and if you want to invest, you stay ready, right? And there are several advertisements given in the time span so that everybody gets aware of the IPO being launched. And the famous the company is, more the number of advertisements, because they have more leeway costs or cost to bear, so they can get more investors. So during this process, the company gets an idea, because of the roadshow, gets an idea about the demand of the share and the price band in which the shares can be sold. And after that, the results are analyzed on the basis of the demand and supply of the share. So then the price band is decided. So ultimately, if you, as an investor, see it on TV or print media, what you will see, you will create a sentiment across the entire around the entire share, and you'll say that okay, this share is worth this much amount of money because I've looked at the financials and it seems to be valued at this price, right? So this general sentiment is taken by the merchant bankers, and they are analyzed, and then the price band is decided, right? And the process of price band, as covered by Ishan, is the book building process of the IPO. So this is the marketing step actually crucial because it makes sure that the prices are not kept too high or too low, because that can affect the subscription of the share, and then it'll create a negative effect on the company. So step five is the building and closure. So as I mentioned before, once the roadshow is done and the price band is decided, the company has to now officially open the window with which through which the public can subscribe the shares. So for example, the price band of the company set by the company is between rupees 80 to 100, and this is actually taken by the public itself. Then the public can subscribe to the shares by placing an order at the price that seems to be fair, right? Now, after the book building is closed, the fixed price of the IPO listing is decided because the company looks at how much the investors have invested at a particular price. In the sense, if it is 95 rupees, then the company will just say that the fixed price that the company share will be traded at in the first day of listing will be rupees 95, right? It's got a fixed price. So this is how it happens. And the sixth step, which is the listing day, this is the day wherein the company actually gets listed to the stock exchange, and the listing price that the public will see is based on the demand for the shares and the amount the company has decided as the fixed price. There are two important IPOs which are mentioned on the slide. This is Nika and Paytm. These are two contrasting examples because Nika launched its IPO during the COVID times, and it was hugely successful because despite of like showing negative returns in the start, the IPO went positive, and there was growth in the share on the first day of listing. In comparison to Paytm, occurred a loss on the first day of listing, and this shows that the company was overvalued because the market sentiment just said that the Paytm is such a big platform and everybody is using it for making digital payments. It should be valued more than the normal value, but the market as a whole decided to bring it down and bring it to its actual price. So this shows that after the IPO, market sentiments depend a lot because it determines the company stance. And through this successful process, a company that is privately limited gets converted into a publicly limited company, and that's how you can trade in the company. So the allotment of shares, this is also a quintessential topic to understand because the allotment of shares depends on the number of subscriptions that the IPO receives, right? So the next slide shows that there are two main cases. The first case is that the total number of bids is less than or equal to the number of shares offered by the company, right? So if the number of bids made by the applicants is less than or equal to the number of shares being offered, then the complete allotment of shares will take place. Thus, every applicant who has applied will receive the assigned number of shares, right? So for example, here the shares are offered at 800 and the bids are 600, which is less than 800. So every applicant will get the number of shares he deserves. The complete allotment of stocks is equal to every applicant receiving the shares. But now to be careful here is the note of caution is if the company tells SEBI that in the listing process, we want 500 plus shares to be bid, right? And but if the number of bids come to be less, like below 500, then the underwriting process takes place wherein the merchant banker himself invests the remaining amount of balance, which in this case can be 100 shares, so that the IPO is successful and the company can move on to the next step. Now moving on to the case two, wherein there are the total number of successful bids is more than the number of shares being offered. Now in this, there can be two cases. Case 2.1, which shows that the number of bids exceeds the number of shares by a small margin. So in this, all investors will be given their minimum lots, and the remaining shares will be proportionately given to the investors who have bid more, right? Who have given the who have bid for more quantity, so that will be allotted to them. And in case 2.2, when the bids greatly exceeds the number of shares being offered, the allotment takes place via a lucky draw, and this lucky draw is computerized without any partiality, right? So the one tip that I have learned while investing is for applying to an IPO, you should always invest in, always put a price of the highest price band, which means if the company has told that a price band of 80 to 100 is set in the previous example, you should always put the price as rupees 100, because that's a greater possibility that the company will give you the shares because they will earn more profit, right? So that's how the computerized system also works, because it tries to generate more profit for the company, and that's why you should always go for the highest price band that the company has shown. And it's important to know that once the IPO is completed, the respective shares will be automatically given into the investor's demand account, which is the account which we learned that stores the stock with the help of the depository after 4 days of the IPO closure, right? So 4 working days, this is the rule of like T plus 4, wherein after 4 working days, you will get the shares in your demat account and you can then trade it in the secondary market.
All right, so let's move on to the secondary market. For this, we'll be exploring what happens in the secondary market. And to do that, first, let's understand how the stock market functions. So to do this, let's just use an example in the form of a story, and we'll go forward from there. So consider a hypothetical situation of a company where the company is facing a succession issue, and most of its senior level management personnel are quitting the company for internal reasons. So as a result, the stock price of this company has dropped all the way from rupees 3,500 per share to rupees 3,000. Now, let's assume that there are two traders, trader 1 and trader 2. Let's move on to see what their viewpoints are on the issue. So, trader 1 believes that the stock price is likely to go down further because the company will find it challenging to find a new CEO to replace the old one. And if trader 1 trades as per his point of view, he should be the seller of the company's stock rather than a buyer. But trader 2 has a different point of view. According to him, the stock price of the company has overreacted to the succession issue, and the company will soon find a great leader. So he feels that the stock price of the company will move upwards. So since he believes this, he believes that he should be a buyer of this company's stock because it will eventually rise and give him a more valuable portfolio. So now let's connect the dots about both of the traders' POVs and understand what exactly is going on here. So At rupees 3,000, trader 1 is saying he will be a seller, but trader 2 says he will be a buyer in the company's stock at that price. So, assuming both of them create a sell and a buy order respectively, it is the job of the stock exchange or the market to match the demand of one trader to the ask of the other traders to get the trade executed. This shows the primary job of the secondary market to create a marketplace for the buyer and the sellers alike.
Okay, so moving on to what moves a secondary market. So there are two types of movement, positive and a negative. So first of all, the price moves because of the expectation of the news and the events, and the news can be directly related to the company, industry, or economy as a whole, and this results in either positive movement because the price will go up then, or a negative movement when the price will go down. So to understand positive movements, we'll take an example. So imagine you are taking a part, you are a market participant tracking a company, which is Infosys. And this at 10 a.m. on 15th of July, the price of Infosys is rupees 2,000, right? And the management makes a statement that the company have managed to find a new CEO who is expected to steer the company to greater heights. Right after this news, this is what happens. The table summarizes it. So at 10:01, 2002 is the price, you will buy it. 10:02, 2006 is the price, you will buy it. 10:03, 2009 is the price. Again, you will buy it. 10:04 to 2050, 15 is the price, and 10:05 2020 is the price. So as you can see, the news itself, wherein the company just announced a new CEO being joined in the company, has created a rise in the price. Only in a matter of 5 minutes, the company has grown 18 rupees of the share, right? And in all instances, you will buy because you have a nudge that this company will grow further and you want to book more profit, right? So for example, if a 10:01 a.m. trader buys at 2002 and 4 minutes later, if he sells it at 2020, he'll earn a profit of 18 rupees in just a matter of 4 minutes, right? That's the effect of the news. So this is actually not a fixture situation. This is a very realistic type of behavioral stocks, because the stock prices tend to go up and people buy the stocks when the news is good or expected to be good. Now moving on to the negative movement. Now, negative movement, again, we have to take an example. So now on the same day, considering the same example, at 12:30 p.m., the National Association of Software and Services Company, which is called as a NASSCOM, it is, for those who don't know, it is considered to be a very powerful organization, and whatever they say has an impact on the IT industry. So the NASSCOM makes a statement right now, and it states that due to the predicted second wave, COVID-19 wave, there would be a 15% shrink in the IT industry, and thus this will have an impact on the industry going forward, because this means that the revenues and profits of IT companies will most likely to go down soon, and this is not a great news for the IT industry. Now, because Infosys is a leading IT player or major IT player in the country, it will react to this news, and the reaction would be mixed, because earlier during the day, there was a good news for Infosys because they were getting the CEO. But however, during the afternoon, they got a news that there is a 15% decline in the overall IT profit, which is a serious matter. Hence, Infosys stocks are likely to trade lower. This means that the stock price will tend to go down and people will start selling the stock because there is a bad news. So the negative news has overpowered the positive news, and this is quite a movement that happens because negative news is taken more strongly than the positive news. So that's about positive and negative movement. Now, how does a stock really get traded?
Step 1. You need to place an order to buy the company stock. So first, you need to log into trading account, which is provided by your stockbroker, and place an order to buy Infosys. And so once you place an order tickets get generated containing the following details: the details of your trading account through which you intend to buy Infosys shares, the price at which you intend to buy Infosys shares, and the number of shares that you intend to buy. And then you move on to step 2, which is before your broker transmits this order to the exchange, they need to ensure and check whether you have sufficient money to buy the shares. And so when this is confirmed, the order hits the stock exchange, then the stock exchange, utilizing their order matching algorithm, tries to find a seller who is willing to share you, for example, 200 shares of Infosys in 2050. And step 3 is that it's the usage of the order matching algorithm. And so now the seller could be one person willing to share the entire 200 shares in 2050, or it could be 10 people willing to share 20 shares each. So the permutation and combinations don't really matter in this case. And so from your perspective, all you need is 200 shares of Infosys in 2050. And the fourth step and the last step is the trade execution. So once the correct match is found, the trade is executed, and the shares will be credited or come in to the buyer's DMAT account, and the shares will be debited or go out from the seller's DMAT account, thereby allowing the shares to get traded from one investor to another investor. And the transferring of the shares and money happen in 2 days' time. And so the SEBI has prescribed a rule of T+2, which means that the funds and stocks should be transferred within the traded date and plus the 2 days by the clearinghouse.
Great. So now that we have understood the primary market and the secondary market functioning, let's take a case study on Rakesh Jhunjhunwala's success story. Rakesh Jhunjhunwala is a successful investor and is called as the big bull of the Indian stock market because he has really implied the investment strategies and made returns that helped him grow. So here we'll play a video that shows how Rakesh Jhunjhunwala grew from like rupees 2,000 to rupees 20,000 crores.
This is the story of Rakesh Jhunjhunwala and how he turned a mere 5,000 rupees into a massive 20,000 crore rupees. Rakesh Jhunjhunwala is arguably the king of Indian stock market. His success has inspired millions of Indians to participate in the Indian stock market, and his story is now a case study in almost every business school. And why not? He is one of the richest men around, with Forbes ranking him number 61st in the list of richest people in India in 2018. And what makes it more impressive is the fact that Mr. Jhunjhunwala was not born into an influential family like that of Tatas or Birlas or Ambanis. He is a self-made billionaire who some even call Big Bull or Warren Buffett of India. So, what makes this man special? And more importantly, what is that you and I can learn from his success? For that, let's start from the beginning, his childhood. Rakesh was born in 1965 in a middle-class family. His father was an income tax officer and his mother was a housewife. His father was interested in stocks, though he was not an active trader. When Rakesh was a young child, he would listen to his father and his friends discuss about stock market, and he would listen to them very carefully. One day, out of curiosity, he asked his father a very perceptive question. Why do the stock prices fluctuate on a daily basis? See, this is a very perceptive question for a 9-year-old kid. So instead of giving any complex explanations, his father told him a very simple answer that why don't you go check the news on a company called Gwalior Rayon in the newspaper. If there is any news about the company, the stock prices will fluctuate the next day. And that's exactly what happened. So in this way, young Rakesh got fascinated with the stock market and learned a lot from his father's detailed explanations. His father knew that Rakesh was destined to go to stock market, but he advised that do whatever you want to do in life, but at least get professionally qualified. So Rakesh completed his graduation from Mumbai Sydenham College, took up chartered accountancy and became a chartered accountant in 1985. After finishing his studies, Rakesh told his father he wanted to go to the stock market. His father knew that this was going to happen. So even though he was reluctant at first, he encouraged Rakesh to pursue his dreams, but just kept one condition, that don't ask for money from me and my friends. I think it takes a lot of heart for a father to encourage his kids to pursue their dreams despite having his personal objections. I think at the back of their mind was the fact that if nothing works out, Rakesh could always go back to his CA practice. And this sense of security gave Rakesh the courage to do what he did next. Here is where he started his stock market journey. So Rakesh shifted to the financial capital of India, Mumbai, with his brother, who was also a practicing chartered accountant himself. The biggest challenge in front of Rakesh was that he had no money to invest or trade. After all, making money from stock market also requires money, and he only had 5,000 rupees in his account and he didn't have the option of borrowing money from his friends or family. But he got his first lucky break through his brother, who introduced Rakesh to a lady who was willing to loan 2.5 lakh rupees provided he can earn some decent returns on them. Later, he got another client through his brother's reference who loaned him another 5 lakh rupees. So now Mr. Jhunjhunwala had 7.5 lakh rupees to get started. Remember, 7.5 lakh rupees may not look like a big amount today, but we are talking about 1985 here. So in today's term, it would be equivalent to having about 30 to 40 lakh rupees. So the first hurdle was crossed. Rakesh now had the money. The question was, what exactly was he going to do with that money? He actively started looking for trading opportunities in the market. Yes, the ace investor that we know and admire today actually started out as a trader, not an investor. He made his first big profit in Tata Tea, a stock that he bought for 43 rupees and which shot up to 143 rupees within a matter of 3 months. So by taking some similar very astute trades between 1986 to 1989, Mr. Jhunjhunwala earned about 20 to 25 lakh rupees and his net worth went up to 50 lakh rupees. Now he struggled for the next couple of years, but then he got the next major breakthrough of his career. He saw a great opportunity in a company called Sisa Goa, which is now part of the Vedanta Group. There was a depression in the iron ore industry and the stock of Sisa Goa was trading at a very discounted price of 24 to 25 rupees. Mr. Jhunjhunwala saw a huge opportunity in this undervalued stock and bought 1 crore worth, which he later sold at 3 to 5 times higher prices. This single trade catapulted his net worth to 2.5 crores. But the best was yet to come. In 1989, there was a lot of pessimism in the stock market regarding the budget that was going to be presented by VP Singh's government. The market had significantly corrected before the budget because it was assumed broadly that it would not be a business-friendly budget. But Mr. Jhunjhunwala's gut instinct told him that Mr. VP Singh, who basically comes from a business background himself, would never present a budget that will be bad for the business. So what did he do? At the time when everybody was pessimistic, Mr. Jhunjhunwala bought aggressively and his instincts turned out to be right. The budget turned out to be business friendly and the market rallied so heavily that in the next few months, Mr. Jhunjhunwala's net worth went up 20 times from 2.5 crores to 50 crores. This one event inspires me the most about Rakesh Jhunjhunwala's journey, that not only he had good trading instincts, but he also had the guts to go big on them. So it's not sufficient that you can spot good trading opportunities. You should also have the confidence to move decisively on those instincts. And that's what differentiates men from boys. Before moving on, let's pause here to absorb another fact, that it is not investing, rather trading, that earned him the capital to become a billionaire in future. So he started with trading to generate the capital and later on switched to investing to multiply that capital. In other words, trading for generating the capital and investing for long-term wealth. Later in his career, Mr. Jhunjhunwala started his own investment company called Rare Enterprises, and the name Rare basically comes from initial 2 letters of Rakesh and the 2 letters of his wife Rekha. So from here onwards, trading took a backseat and Jhunjhunwala slowly shifted towards investing. Over the years, he has made some really profitable bets on companies like Titan, Lupin, Crisil and Praj Industries and several other companies, which catapulted his wealth to 20,000 crore rupees as of 2018. It is also important to understand that not every investment that Mr. Jhunjhunwala made was successful. In fact, he has incurred significant losses in investments such as Mandhana Retail Ventures, DHFL, Geojit Financials and whole lot of companies. But what sets Mr. Jhunjhunwala apart from other regular investors is that he is not easily scared by short-term volatility in the stock market. He is very careful in analyzing the fundamentals of the company, and until the fundamentals of the company are intact, he doesn't care whether the stock goes up or down. His philosophy is that over a period of time, some stocks will underperform and some stocks will overperform. But India's growth story has just begun and eventually every patient investor will make money. So this has been the journey of this ace investor. On the personal side, very few people know this, but Mr. Jhunjhunwala is also an influential personality in Bollywood. He has produced several Bollywood films and he is also very media savvy, and you can see him regularly on every major business channel. A very admirable and underappreciated fact about Mr. Jhunjhunwala is he is also a big philanthropist. He has publicly declared that by 2020, at his 60th birthday, he will donate a significant portion of his wealth to charities. So that tells me that the man not only has a brains, but also has a big heart. So I hope that you were also inspired by Mr. Jhunjhunwala's life story. Do check out the video on the top 5 lessons that we can learn from Mr. Jhunjhunwala's investment philosophy. The link is in the description below.
So now that you have watched this inspirational video, there are a few questions that you should consider. So the first one is actually a debatable one, which is that just came to my mind, which is whether taking this risk in the stock market is appropriate or not, and if yes, what should the risk be taken on? Like what judgment should be made so that you know that you are taking a good risk and it will award a good return. And the other question that you should consider is what was Rakesh Jhunjhunwala's trading strategy? What mentality should be used while trading? Like what should be the capacity to incur loss, and how much capital should you deploy to the stock market so that you are safe on both hands in income and as well as earning? And what is the value of patience in trading? So now let's move on to the most important part of it, where it is called power of compounding. So we'll understand what is compounding and how it works in the stock market and how it can help you as an investor to earn more money. So the power of compounding is a method by which an investor can make their money work for them, because what the power compounding does is the interest is added up to the principal amount and the new amount is reinvested. So this means that um, it's an earning interest on interest or profit on profit, right? And this strategy allows the interest earned to also earn interest, leading to a growth in the value of investment. So let's consider an example. Let's assume that you invest rupees 5,000 in mutual fund, and starting at the age of 15, you invest the amount. Considering that an average mutual fund gives a return of 12% interest per year, nowadays it's more like it's 13 to 14%. You will make a total amount of rupees 2.5 crore by the age of 50, which is after 35 years, right? This shows that, like, by just investing rupees 5,000 in a mutual fund at the age of 15 and assuming that the market does not crash in between and it gives the returns, you will jump up the money from rupees 5,000 to rupees 2.5 crore at the age of 50. But if you had started at the age of 30, you would have only made rupees 43 lakhs by the age of 50, because there was less amount of time for for the money to grow. So in the previous example, there was 35 years, and in this example, there are only 20 years, right? So this shows that the power of compounding and time have a direct relation, and compounding for more time means that you will have more earnings and vice versa. So time is actually equal to money. So using the power of compounding is also an important aspect. So this again shows the graphical representation of what the power of compounding looks like. So here, Jack invests rupees dollars 200 per month, starting at the age of 25, and this money at the age of 65 gets to dollars 96,000, right? Whereas Jill invests the same amount at the age of 35, but ends up with dollars 70,000, and Joey invests the same amount at the age of 45, which gets her to dollars 48,000. So here you can see age is very important factor, wherein because the amount is same, but the time difference is greater, Jack makes the most out of all of the investments made by the other investors, and this leads him to be more wealthy in terms of receiving income, as well as he has applied his learnings well, so that because he started investing early. So we'll move on to the using of the power of compounding. So first step is actually to start early, because the longer the investment horizon, the better. So starting early facilitates a longer time, and this in turn adds to the magic of compounding, as more interest on interest can be earned and better wealth can be created. Second step is that invest wisely, because you want to seek high returns on investment. So the investment ought to yield an appealing rate of return, whereby the investor is able to get abnormal profits by the end of the compounding. And third is to invest regularly and grow the investments. So make it a point that you want to save more and add more to the investments, because investing regularly allows investors to keep a track of the markets. You can shuffle certain stocks and make profits on the way itself. So majority of the times, power of compounding is not always long-term gains. It can also be short-term gains, because you can churn your portfolio as and when you go, and you can keep certain stocks for long-term gains. But that stock allows you to receive the power of compounding, and that money which associated with the stock grows. So I just want to say that the earlier you invest, the more benefits you will reap, because time is equal to money, quite literally, in this power of compounding concept.
Okay, so now we come to the section that most of you have probably joined for. It's that learning how teens can start investing. So I know I've had a pretty long session so far, but I hope you pay attention now, because it's very important, as we will detail the steps and give a brief explanation for the steps and processes you have to complete in order to begin your investment journey. So the first step is the importance of selecting a bank. So you'll need to select a bank that allows you to open a custodial account, which is a trading account for minors or teenagers like yourself. And in India, the following prominent banks can offer these services to you. Examples like the ICICI Bank, Kotak Mahindra, HDFC, Axis, State Bank of India, and IndusInd Bank are also very prominent examples that allow users to make a custodial account and allow teenagers to begin trading online. So recommendation is that an easier and effective method to open a custodial account is through Upstocks, which is a user-friendly platform that you can find online. So we can give some more information about that if you want, just ask us in the comment below. So step 2, which is contacting that bank. So after you've selected your bank and you know what path you want to take down, the following below mentioned tips are very important. So first is to search for the nearest bank branch online, and then contact the branch through their number that you get from the website or from any retailer. Booking an appointment and requesting for an open bank account is something you can do when you're on site at the actual location. And make sure that you go to the bank along with your guardian, as their presence will be required and will also allow them to oversee the decisions that you're making at the bank. So next is the importance of getting the PAN card and the KYC details. The following 2 points are a must in opening a custodial account, because they show a valid proof of identity, which is required to open a custodial account when you're starting investing. So the first is the PAN card. So the PAN card is a permanent account number issued by the Income Tax Department, which serves as a proof of your age. Minors can create a PAN card and this process can now happen online through the Online PAN Application, NSDL, or Apply a PAN Income Tax Department. The KYC, which is the second pillar of this, stands for Know Your Client. It is a mandatory process of verifying the client's identity, and this process includes an identity card, face and document verification, and is done through an online form.
And the important point to note over here is we have a common perception that PAN cards are only made for adults, but that's actually wrong, because I currently hold a PAN card, and because of the PAN card, I was able to make an investment account, right? So you can just go through the portals and search up online how to apply for a PAN card in India. And the process is quite simple, because you'll get the PAN card within few business days, right? So yeah.
Right. So the final step that you're required to open a custodial account for yourself is to obtain any remaining documents that are required by the bank and during the process of opening an account. So any one of the documents from each of these 2 categories is required. The first being a proof of identification, or POI, which can either be your passport, an Aadhaar card, or a PAN card, which most of you have access to. And the second is a proof of address, which also includes either your passport, Aadhaar card, or a bank passbook or statement that you received from your parents. So this 4-step process only takes about 7 days to complete. And after that, you have your own custodial account, which means that you finally have the legal right to invest in the stock market under a guardian and begin your stock investment journey.
Yeah, that's all for chapter 5. Thank you so much.